Welcome back to our second presentation for financial statements and ratio analysis. And we'll be now doing some actual calculations. So we need you to get might want to have the formula sheet. That makes life a little bit easier. Let's go take a look at the formula sheet. It's in Canvas and on the class website. And then you want to have at least the balance sheet available for Sprouts and the income statement. And you can have the cash flow statement available also. So let's get started with the profitability ratios. The profitability ratios are financial ratios that measure a firm's returns by relating the profits to the sales, profits to the assets, profits to the equity. And the very popular ones are the net profit margin, the return on assets, and the return on equity. The others are important also. Profitability ratios allow one to measure the ability of a firm to earn an adequate return on sales, on assets, on equity, and invested capital. So let's go through each one separately. The net profit margin, or sometimes called the after-tax profit margin, is the rate of profit being earned from earnings after expenses and taxes. So we take our net income, that's the bottom line number on the income statement, and we divide it by the total revenue. That's the top line number. So the higher the number, the better. And of course, it varies greatly from industry to industry. And as we said in our previous presentation, we must always look at the competitors and the industry as a whole whenever we do any of these calculations. So where would we find the net income and the total revenue? If you look at the formula sheet, it'll tell you, but they're on the income statement. So let's call up the income statement. Here is the total revenue. That's the top line number, 6468759. Remember, you have to multiply everything by 1,000, so that's 6 billion, by the way, 468,759,000. And what's the bottom line number? 287,450. Those are the net income, the net profits, the bottom line. So taking the bottom line number, dividing it by the top line number, I get 4.44%. Now remembering, this is the end of 2020. So normally what we would do is we would do trailing 12 months. We would look at the most recent quarter and go back 12 months. But we're just learning how to do it, so we don't care that it's 9 months, 10 months old. So we get 4.44%. Is that high? Is that low? Well, I don't know. You got to look at their competitors to see if that's a reasonable number. And you think, oh, Sprouts is in a pretty darn competitive industry, right? Groceries. They're trying to differentiate themselves from the Vons and the Safeways and the Alberts and the Albertsons and the others. But still, they're more competitor of Trader Joe's and Whole Foods. But still, it's still in the grocery business, and it's a tough business. So 4.4%, we look at the competitors and we find out, no, it's respectable number. The next one is the gross margin. The gross margin just looks at the gross profit, which is fairly simple to calculate, and divides that by the total revenue. And of course, we don't even have to calculate it because it's done for us. If we go to the income statement, we see that the total revenue is subtracted by the cost of goods sold, or the cost of revenue. In other words, what Sprouts had to pay for the things that it sold. So their gross profit was $2,379,289,000. Right? We just write don't worry about the zeros. And we divide that by the total revenue, and the same number that we had before, and I get 36.78%. Well, what is that telling us? Well, that's telling us that pretty much, and this is what we'd expect in stores, that, they're paying 70% of 60% of what we would have to pay for the retail. They're getting it wholesale. So they're buying, they're not buying one package of tomato paste. They're buying pallets, whole truckloads. So they get a very much better price than we do. And that's their gross margin. And again, the higher the better, and it varies greatly from industry to industry. So we must always look at the competitors. The operating margin takes the gross margin one step further. That's the rate of profit being earned from the operating income. And yep, you guessed it, the higher the better. It varies greatly from industry to industry. So we'll say it again, when we're looking at a specific company, we always need to look at its competitors within the industry. When we find a company that is atypical of its competitors in the industry, it's a signal that we have more investigative work to do. So we look for the operating income. We find that that goes one step further. The gross profit looked at the cost of the revenue, the cost of goods sold. The operating profit said, okay, how much did it cost us in overhead, in rent and payroll, and all the other selling, general, and administrative costs? And it turns out their total operating expenses were close to $2 billion, $1,987,993, divided by that top line number again, 646875 now. I'm going a little quickly, so you stop the presentation and you do it. Make sure you get out your 99-cent calculator and do it, and make sure I got the right number, because who knows, I do mess things up. And I get an operating margin of 6.04. Is that right? Operating income. Oh yeah, what did I do? Did I get the right? I'm sorry. I told you to use the operating expenses. Oops. No, that's not. I told you. See, you gotta be careful. You gotta watch me. That's the operating expenses. The operating income was $391 million. Right. This is payroll. Right. A lot of it's payroll, just because it has, you need people, and so 391,296,000. That divided by the top line number gives us a little over 6%, right? That makes a whole lot more sense. And then we would look at their competitors to see if those are good numbers. So those were comparing the profits and the different types of income and profits to the revenue. Now we're going to take a look and compare the income, the bottom line number, with our total assets, which are on the balance sheet. And this is a measure of how profitable a company is relative to its total assets. The return on assets looks at the amount of resources a company needs to support their operations. It reveals how effective the company is in generating profits from the assets it has available. This is a very popular ratio. So we remember the bottom line number for the income, 287,450. But now we have to go on over to the balance sheet and find the total assets. And here they are, $3,150,000,000. So dividing the net income, the bottom line number of 287,450, by the total assets, 3,150,000,000, and we get a number of 9.13%, which, I'm guessing, I'm not an expert in the retail field, certainly not in groceries, but I'm guessing that's pretty darn respectable for the amount of assets they have to produce that profit. The next one is return on equity, which doesn't look at all the assets, it just looks at the total stockholders' equity. It's a measure of the overall profitability of a company in relation to what the shareholders own. Not what's owed, but what's left over. Because return on equity uses shareholders' equity, because return on equity uses stockholders' equity, which is the same thing as shareholders' equity, instead of total assets for the denominator, return on equity is very sensitive to the amount of debt a company is carrying. If a company carries a great amount of debt, the return on equity will be much larger than the return on assets. And why is this? It's called leverage. And we're going to use this term throughout the semester. It is, you are using other people's money to make your money. Now, some people view this positively, especially more aggressive investors, because you were able to do more with borrowed money. Others are worried about the possible negative consequences of too much debt, because debt is a dual-edged sword. It can help you do things that you couldn't do without the money that you borrowed, but at the same time, you got to pay it back. And so that can, when there's a recession or whatever happens, that can become very, very tricky. And that's the same thing is true, just with us working grunts. There's just a whole lot fewer zeros behind the numbers. Whereas you work with corporations, there's a whole lot of zeros. So what's the return on equity for Sprouts? Well, we use that same bottom line number, and if you remember, that was 287,450. But then we go to the balance sheet and find that the total stockholders' equity is only 881,290. Remember, the total assets were over $3 billion. So 881,290 divided into the net income of 287,450 gives us a return on equity of over 30%, which is pretty darn good. But remembering that Sprouts borrowed a lot of that money so that they could produce that net income. So they've been very aggressive in their borrowing. And we saw that in the previous presentation where we saw the balance sheet. Let's take a look at it very quickly again. We saw that their debt level, their debt level went up quite a bit in the last few years, and they're taking advantage of generational low interest rates. So that was the return on equity. Now, a popular ratio is called return on invested capital. The problem with this ratio is that there's a few different ways to calculate it, and we're using the most simplistic version. This is a ratio that Warren Buffett likes to point to. This is the measure of the overall profitability of a company in relation to both debt and equity. So we use the net income and subtract out any dividends. Well, we don't have to worry about that because Sprouts doesn't pay dividends. And then we take the long-term debt and the total stockholders' equity in the denominator. By using both long-term debt and stockholders' equity, return on invested capital measures how well a company is managing all the capital that the company needs to earn its profits. So it's as we said, there's various versions of it, and we're using the most simplistic. So you could do a little bit more researching if you felt that this was a ratio that you really wanted to keep track of. So let's see, what do we need? We need the net income. Well, that's on the income statement. We need the long-term debt and the total stockholders' equity. Well, we've used the net income quite a bit, 287,450, and we see that they're not actually paying any dividends. Sprouts doesn't pay dividends, so we don't have to do any subtraction. And so we take a look at the long-term debt of $1,330,000,000, and we add to that the stockholders' equity of $881,290, and I got a subtotal of $2,211,920. So 211,920. You check it out. Make sure I did it right, because I mess up. And dividing that into that net income of 287,450 gives us a return on invested capital of 13%, which, depending on we have to look at the competitors, but that's pretty substantial. That's a pretty darn good return on your invested capital, in my humble opinion. And so you decide. Okay, those were the profitability ratios. I know it's a little tedious, but slog through them and you will see that as a whole, these help us see the bigger picture, round out our research. The liquidity ratios, very popular, especially the current ratio and the acid test ratio. The net working capital is actually a little bit of a strange duck in this chapter. These financial liquidity ratios are concerned with a firm's ability to meet its day-to-day operating expenses and satisfy its short-term obligations as they come due. In other words, can you make payroll? Are you in danger of closing the doors? The popular ones, as we said, are the current ratio and the acid test ratio. And we'll see that net working capital is a little bit of a strange duck. It's not a ratio at all, so we'll see that. Okay, so the current ratio, one of the more, as we said, popular financial ratios. It's a good indicator of how stable a company is. Anything over 1.0 is normally considered acceptable. If your current assets equal or exceed your current liabilities, you should be able to satisfy your short-term obligations without any problem whatsoever. Obviously, the greater the number is, the better. So you take current assets divided by current liabilities. Where do we find those? On the balance sheet. What are our current assets? $465,950. Everybody see that? And what are our current liabilities? $496,140. So by dividing $496,950 divided by $496,140, I get 0.939. Not quite 1, which would mean that the two were equal. So in reality, our current assets are a little bit less than our current liabilities. Now, is that a cause for alarm? It depends on the situation, on the company, and what kind of numbers we're talking about. Because what we're going to do next is we're then going to look at the net working capital. The net working capital is not a ratio. It's the current ratio in absolute dollar terms. If the current ratio is greater than 1, then net working capital will be positive because we're going to take current assets and subtract the current liabilities. If the current ratio is less than 1, then the net working capital will be negative. Because if current assets are greater than current liabilities, you'll have a greater than 1 current ratio, and vice versa. If the current assets are less than current liabilities, it'll be below 1. In our case, it's below 1. So we may be concerned. We might say, well, I don't know. Sprouts, I don't know about Sprouts. So what we're going to do is we're going to do that calculation. We're going to take $465,950 and subtract the $496,140. Okay, if I'm going too fast, just stop, slow down, go back and make sure you find these numbers. And that turns out to be $30,190,000. So they have $30 million less than in their current assets than in their current liabilities. Now that's a lot of money to you and me, right? That's a lot, 30 million. But to a corporation the size of Sprouts, they have plenty of resources, plenty of places to make up any short-term deficit they may have. And notice they have $170 million in cash. So yeah, they can make their payroll, they can pay off their debts without any problem. And if push comes to shove, they have plenty of resources. So the net working capital makes us feel a little bit better because the negative isn't that bad, right? In my humble opinion. Other people might say, oh no, I'm getting kind of worried about Sprouts. And other people might say, what are you talking about? There's nothing to worry about. They're not going anywhere. The next one is a more stringent version of the current ratio. Isn't that a great name? Acid test ratio, the acid test ratio. Sometimes called the quick ratio. Well, here's the difficult way to do it, and I don't like to do that. I like the easier way. What you do is you pull out the inventory Unlike the current ratio, the acid test ratio excludes the inventory. So this ratio measures the ability of the company to meet its short-term obligations, even if its current inventory becomes obsolete or undesirable, and hence difficult or impossible to be turned into cash. So think about it. If you're a computer company, your inventory goes obsolete very quickly, right? And this is what Dell did in the 1980s. They, now they're not the only one now. A lot of people do this, what's called just-in-time inventory. They would wait. They'd make certain models, but they wouldn't build the inventory. They would wait till somebody asked for them, and then they would build them right away and send them out the door. And so, because they didn't want to be holding on to any computers that were 6 months old because nobody wants to buy them. Does the inventory that Sprouts have, is that going to go obsolete? I mean, some of it's going to spoil if they don't get it out the door. But the other stuff, no, the Cheerios are going to be fine for a while. So we don't really have to worry too much, I think. I don't know the grocery industry as well as some other people, but let's do it. Let's take the current assets and subtract out the inventory. The other way is to just add up all these that is not inventory. So either one, you decide. The current assets are $465,950. The inventory is $254,220. That doesn't give us much left, does it? That gives us $211,730. And if we divide that by the current total liabilities, we only get an asset test ratio of 0.427. We take the current assets, subtract out the inventory, which is a $254 million worth of inventory, and we get $211,730. Make sure you got that number. You divide that by the total current liabilities, and you get 0.427. In other words, 42.7%. We have to now think and analyze and wonder, is that a bad sign? Well, for some companies whose inventory can become obsolete, and then it would be, maybe impossible, or they'd have to really mark it down to get it out the doors. Yeah, that'd be a big deal. But for Sprouts, if you ever worked in the grocery industry, you know that a lot of stuff is gone within weeks or within days, and so I'm thinking, although I'm not an expert at retail at the very least, I'm thinking that no, it's not a big deal. And obviously Sprouts management doesn't think it's a big deal either, or they wouldn't be allowing their acid test ratio to fall so lowly. Cool? Okay. Slide number 31. Let's take a look at the activity ratios. These are financial ratios that are used to measure how well a firm is managing its assets, how efficient they are with their assets. We'll take a look at accounts receivable turnover, inventory turnover, and total assets turnover. We use both the balance sheet and the income statement. Activity ratios measure a firm's ability to convert different accounts within their balance sheets into cash or sales. Companies will try to turn their production into cash or sales as fast as possible because this will generally lead to higher revenues. In other words, get this stuff out the door, right? So let's take a look at the first one. Now, what's accounts receivable? If you've taken accounting, you know what that is. That's money that is owed to us. And some business to business, or almost all business to business firms, they work on accounts receivable. You sell the products, but they don't get paid. You send the company that bought the materials from you. You send them an invoice, and you give them. You might have heard 30 days net or 60 days net, and so they get a short term to pay you back. So the higher the number, the better, because that means we're not leaving money on the table out there waiting for people to pay us. It indicates the return a company is getting from its investment in accounts receivable. By maintaining accounts receivable, firms are indirectly extending interest-free loans to their clients. Now, why would they do this? They want the business. A high ratio implies that the company operates either on a cash basis or their clients are very good at paying them quickly. The extension of credit and collection of accounts receivable is efficient. A low ratio implies that the company should reassess its credit policies in order to ensure the timely collection of imparted credit, not earning interest for the firm. Or what does that mean? In other words, these people are not paying us. we got to do something about this. Or it may be that that's just how the industry operates. And a good example of this is the defense industry. Uncle Sam does pay his debts. Don't worry, he's not going to stiff you for that aircraft carrier that you built for him. But he takes his good old sweet time to do it. And the larger defense contractors just, they're used to this. But there was a movement back in the 70s and 1970s and early 80s to get more smaller contractors involved with the Defense Department. And so they, big deal. Come on, we want you to bid on these contracts, and we'll award these contracts to smaller companies. And then the small companies said, "Great, let's get involved in this." And then they, sold them the goods or services, and they waited to get paid, and they sent them an invoice, and they waited to get paid, and they sent them another invoice, and they called them up and said, "What's going on?" "Oh, don't worry, we'll get to you." And the small vendors just said, "No, we can't do business like this. You have to pay us quicker." And my understanding is, I haven't been involved in the Defense Department in a million years, but my understanding is they're paying their bills faster. So we take the total revenue and we divide it by the accounts receivable. Well, if we go to the total revenue, that's on the the income statement. Total revenue of $6,468,759,000. And we divide that by the accounts receivable of $23,640,000. You see, Sprouts mostly has people pay them when you go in the store. You get a number 273.636. In other words, every it's like every day, 53 would be every day. I'm sorry, no, almost every day. Almost 365 would be every day. So almost every 2 days, the accounts receivable turns over. So yeah, we don't have to worry. No problem, Sprouts and accounts receivable. No problem. So do that again. Take the total revenue, that 6 billion number, 6,468,759, divided by the measly little 23,640,000, and you get a number over 273, which means every not quite every day would be 365, right? So a day and a couple of hours. The accounts receivable turns over. Pretty darn good. But that's not the truth for inventory. Inventory is the same idea. We take the total revenue and divide it by the inventory. The higher the number, the less time an item spends in inventory, and the better the return the company is able to earn from funds tied up in inventory. As with all ratios, we must compare this against the industry average. A low turnover implies poor sales and therefore excess inventory. A high ratio implies either strong sales or they're just not taking care of their inventory. High inventory levels are unhealthy because they represent an investment with a rate of return of 0. And it also opens the company up to trouble in the case of falling prices or obsolete products, as we discussed with the quick ratio. So think about the poor car dealer. They want to have as many cars on the lot to get people excited about coming in and buying a car, but at the same time, they want to have as few cars on the lot because those cars that are on the lot are not making them any money, right? It's only when they sell them they make the money. So it's one of those balancing acts. If we take the total revenue divided by the inventory, remember that 6,468,759, and divided by the 253 $54,220,000, 254,220. It turns out that Sprouts is turning over their inventory 25 times a year. So in other words, every 2 weeks, you walk into a Sprouts, 2 weeks later, everything is new. Now, if you've ever worked in a grocery store, you know some things are turning over every day, and other things, take a little bit longer to turn over. But that's what Sprouts is turning over their inventory. So it's not likely that Sprouts' inventory is going to become obsolete. Assuming they're selling all their produce, that goes obsolete quickly. But everything else, the canned food, is good for a long time and the like. So that's the turnover for Sprouts. And we would look at, if we were an industry analyst or an industry expert, we'd look at their competitors and see how well they're doing. And then the total asset turnover is a measure of how the total assets are managed. The total revenue divided by total assets measures the firm's efficiency at using assets to support sales and revenue. The higher the number, the better. Companies with low profit margins tend to have high asset turnover, and those with high profit margins have low asset turnover. So in our case, we take the total revenue, there's that 6 billion number, 6,468,759, and we go to the balance sheet and look at the total assets, 3,150,000. So that's the number we use on the bottom. And it turns out that they are turning over the assets about twice a year, right? Every 6 months or so. And that's something we would compare to their competitors. Whew. I know it's a slog, but we go through these and it's pretty straightforward, isn't it? You're pretty straightforward. So our last group, the leverage ratios. There's that word again. Leverage, also called solvency ratios. These are financial ratios that are used to measure the amount of debt being used to support operations and the ability of the firm to service this debt. For those of us who are nervous Nellies when it comes to borrowed money. The debt to equity ratio, the times interest earned, the total debt to total assets, and total debt to capitalization. As we said, debt is often referred to as leverage. The idea is that you are using other people's money to make your money. You are using the borrowed money as a lever to increase your earnings. When one firm buys another firm using borrowed money, it is often referred to as a leveraged buyout. And we're going to come back to this idea because leverage is used in other parts of investing. It is the lifeblood of real estate investors. And we can also use it when we purchase stocks, that we'll see at the end of the semester. So there's a two-edged sword, isn't there? It can help us get from point A to point B because we didn't have the cash to get there. Now we do because we borrowed it. But now we got to pay it back with interest. 36, slide 36, the debt to equity ratio. Important ratio in my humble opinion. This is a measure of a company's financial leverage, their debt, calculated by dividing the long-term debt by the shareholders' equity. It indicates what proportion of equity and debt the company is using to finance its assets. You take the long-term debt and divide it by the total stockholders' equity. A higher debt to equity ratio generally means that a company has been aggressive in financing its growth with debt. This can result in lower earnings. Why? Because we have to pay the interest, and that is tax deductible, unlike dividends, which are not tax deductible, and hence we pay fewer dollars in taxes. Sometimes investors will use total liabilities instead of the long-term debt. And for us more risk-averse investors, the lower the number, the better. So we're going to go get the long-term debt and the total stockholders' equity from the balance sheet. So there's the long-term debt, 13300, and the total stockholders' equity, 881,290. And it turns out that their debt to equity ratio is 150%, over 150%. 1.508181 is what your calculator should say, 150.81%. To me, that's really high. I'd like to just think about it, folks. If you were like Sprouts, that would mean you owed far more than you own. Now, is that smart? Well, with interest rates so low, the company said, yeah, let's take advantage of 1% interest rates and borrow at these, or 2%, and we can do what we will with the dollars. A lot of the companies simply turned around and bought back their shares. I don't know that that's that intelligent, but that's what they did. You have to ask them what they think about that. Or paid their shareholders extraordinary dividends. That's what happened to the 2017 tax reduction to corporations. A lot of them spent it all on themselves. Well, that's capitalism, and that's what a lot of economists said. The economists said, you're not going to take that money and turn it into wages for the employees or more efficiency. Your companies are already really efficient, and that's exactly what happened. They just turned around and paid themselves and their shareholders. Okay. Personally, that scares me, 150% for Sprouts. But other people, pish, nothing to worry about. They can pay their interest. And this one, times interest earned, tells you how often throughout the year they meet their fixed interest payments. This was a very, very important ratio for Mr. Benjamin Graham. When you read eventually The Intelligent Investor, you will see he paid a lot of attention to times interest earned. We take the earnings before interest and taxes, and divide the interest expense. Normally, 3 or 4 is considered adequate. That means 3 or 4 times a year you earn your interest. Where do you see? Because interest rates are so low, where do you see the interest times interest earned for Sprouts? We go to the income statement. We go to the income statement and we find their earnings before interest and taxes are $391,665. So $391 million, $665,000. Look at their interest expense. It's not even $15 million, $14,787. So you divide the interest expense by the earnings, divide the earnings before interest and taxes, that's at the numerator, and then the 14 million actually, but 14,787 is in the denominator. And it turns out that every 2 weeks, 26.49, Sprouts is earning their interest for the year. So that would be similar to you or I earning our mortgage payments for the year every 2 weeks. So that you see why they're not. I'm worried about debt. They're not. They're saying, "What are you talking about? We can pay this debt, no problem." So that's why their debt level's so high, because we don't have anything to worry about. At least that's what they think. You never know. But if there's Sprouts, even they're fairly recession-proof because people got to eat, right? Yeah. So that's the times interest earned. And as I said, you will see the master when you read the Intelligent Investor. Don't read it the first book. Don't read it your first book. But when you get around to reading it, you'll see the master at work when he discusses times interest earned. The next leverage ratio is total debt to total assets. Another popular ratio with those of us who are risk averse. We take the total liabilities and divide them by the total assets. Measure how much of a company's assets have been financed by debt. And it includes both short-term debt and long-term debt and assets. If it varies substantially from the debt to equity ratio, the company may be relying heavily on short-term debt. Heavy reliance on a short-term debt can denote more risk. Think of it, folks. It's as if you were trying to finance the operation of your business through credit cards. Hey, and some people do that. They are bound and determined to succeed, so they'll run up their credit cards just to get that business off the ground. Very, very risky. Very, very risky. So if we take the total debt, that's on these are both on the balance sheet. Total debt, where is that? Where did I get that? Total liabilities 2270,000, right? And we divide that by the total assets of 3150000, and we get what is it, 72%, which again is fairly high. Me, I like to see it between 30 and 50%, but that's me. And other people say, oh, what are you worried about? They can make their payments, no problem. So that's the total debt to total assets. And our last one, our last one is total debt to capitalization. So it's very similar to the one we just looked at, but it's a measure of the total amount of outstanding company debt as a percentage of the firm's total capitalization. So we talked about the capitalization of a company. So you take the short-term debt and the long-term debt in the numerator, so it's a little tricky. Short-term debt and the long-term debt and the shareholders' equity in the denominator. So similar to the total debt to total asset ratio, as with other debt ratios, the higher the debt level, the more risk of insolvency. However, some industries with high rates of debt, such as utilities, also have more reliable earnings. So hey, okay, we got a lot of debt, big deal. People don't want to take cold showers in the dark. We're going to get paid. As always, we must compare our results with the competitors and the industry as a whole. So for our last calculation, we got the short-term debt and the long-term debt. And 136, where's the short-term debt? Okay, short-term debt is under current. Here it is. Short-term, no, that's under liabilities. 136,700, right? 136,700. And then the long-term debt, there it is, short-term current. And there's the long-term debt, 1330000. So we add those two together, and I get a numerator of 1466700. You do it. Make sure I'm doing it right. 1466700. And then we're going to add those two together again, short-term debt, long-term debt, and then add the stockholders' equity of 881,290, and I get a denominator of 2348620. So make sure you do that. Make sure, keep me honest. 2348620. So 1466700 divided by 2348620, and we get a total debt to capitalization of 62.45%, which is similar to the total debt to total assets. Cool? And that's our very last ratio. So, summing up, it might seem like we're doing these just for busy work. And in some cases, I would agree with you, because some of them are just, oh, okay, we don't need to know that. And that's fine. That's good. It's not something that is going to derail our other analysis and reading everything we can and doing our predictions and the like. But then again, there's going to be times when we see something ain't right here. What's nuts? This is not like this. One of these things is not like the others, and why is that? Maybe it's a good thing. Maybe usually it's not a good thing. And they will allow us to be forewarned about any potential bugaboos that might come along. Which is why when you watch The Master in Action, Benjamin Graham, you'll see he was able to sniff out some bad situations about companies that everyone thought, oh, this company's doing great. What are you worried about? No problem. Uh-oh. Okay. In our next chapter, we'll be discussing a third type. Well, we haven't done the second one yet. We'll do the second one afterwards. There are two major types of analysis. Fundamental analysis, that's what we're doing right now. With the previous this chapter and the previous chapter, we've been doing fundamental analysis. There's technical analysis, which we'll look at after next chapter. And then we're going to look at the third one that came along, and that's called market efficiency. Or as I like to call it, who can beat the market, right? So we'll see you in our next presentation because, dear students, we have done the heavy lifting, in my humble opinion. We have done the heavy lifting. Do these problems over and over again. The chapter 4, fundamental analysis valuation models. Do these financial statements and ratio analysis calculations, and find companies that speak to you, and make decisions. Because at the end of the day, you gotta make a decision, right? But before you do, let's take a look at what the market efficiency experts and adherents say about our chances of actually doing well. See you in our next presentation, our next chapter, when we take a look at market efficiency theory and who can beat the market. Dear students, thank you so much for being in our class. We are all of us at Southwestern, grateful, happy, privileged, and proud that you're with us.